on the surface, things are looking pretty good, right?
Yeah, if you just look at the surface level, yeah, definitely things look really good.
But obviously, we want to go a little bit deeper here. We've all gotten so used to buying the dip, assuming the market will always bounce back.
The question we all need to be asking ourselves is this: when will the dip be more than just a dip? But what if this time it's different? What if the dip turns into something bigger? A correction that really shakes things up?
We can't just assume things will keep going up forever.
Exactly. Something has to give at some point. Especially with the continued AI boom, they're saying that
You've got questions about the 2025 stock market, and we've got insights. Think of us as your financial Sherpas guiding you through the peaks and valleys of this wild ride. The S&P 500 had an amazing run in 2024, up over 23%. But can it keep climbing? Should you be riding this wave or bracing for a wipeout? That's what we're here to explore.
it's definitely a fascinating landscape right now. What's immediately striking is the dominance of those mega cap stocks we all know. Apple, Nvidia, Microsoft, they're like the giants holding up the entire market.
Yeah, I'm seeing headlines about Apple's market cap being bigger than entire countries. So is this concentration a good thing, like a sign of stability? Or is it a potential risk?
Well, think of it this way. If those few companies stumble, the entire market feels the tremor. We're not just talking about your average dip here. Even the S&P Midcap 400 index, which represents healthy mid-sized companies, is dwarfed by Apple alone. It's unprecedented.
Okay, that sounds a little unnerving. I'm starting to feel those what goes up must come down vibes. But before we jump to conclusions, just to set the stage a little bit, the S&P 500 gained over 23% last year in 2024. And that was on the heels of another big year in 2023. It was up like, what, 24%, something like that?
Yeah, almost 25.
So it's, I mean, on the surface, things are looking pretty good, right?
Yeah, if you just look at the surface level, yeah, definitely things look really good.
But obviously, we want to go a little bit deeper here. So what are some of the things that maybe we should be thinking about as we go below the surface here?
Yeah, I think one of the biggest things is that if you look at the difference between the S&P 500's performance and its equal-weighted counterpart,
Yeah.
you see a pretty big difference. The equal-weighted S&P 500 was only up about 10.9%. So that tells us that a few of those mega cap stocks were really responsible for a lot of those huge gains.
So we're talking about like Apple, Nvidia, Microsoft, the ones that have really been riding the AI wave.
Exactly.
So it sounds like we've got a pretty narrow market here.
Yeah, I mean, 54% of the stocks in the S&P 500 were above their 200-day moving average at the end of the year. So, yeah, it's a pretty narrow market.
So like a few companies are carrying the whole market on their shoulders.
Kind of, yeah.
Yeah.
It's definitely a little bit top-heavy.
And the question is, how long can they keep doing that
Yeah, agreed.
before maybe things start to shift a little bit?
Yeah.
Let's look at some historical patterns. What about that January barometer I've heard so much about? Does a strong January usually mean a strong year overall?
It's a compelling indicator. Historically, a positive January has often predicted a positive year for the S&P 500, but there's a wrinkle this time around.
Oh, tell me more. What's the catch?
The Santa Claus rally, that period spanning the last few days of December and the first couple in January, usually sees a nice little bump.
Yeah.
This year it fizzled. We actually saw a decline during that period.
So mixed signals. But that Santa Claus slump is throwing some shade on the festivities. What else should we be factoring in?
We can't ignore the political landscape. We're in a new presidential administration. And the transition period, from the start of the year to Inauguration Day, has historically been a bit of a roller coaster for the market.
Okay, so we're talking potential volatility. Give me some historical context here. How have past transitions played out?
There have been some wild swings. Back in 1997, during Bill Clinton's second term, the S&P 500 climbed almost 5% during this transition period. But then you have 1933, right in the thick of the Great Depression, when the market plummeted over 15%, leading up to FDR's inauguration.
Whoa, that's a huge contrast.
Yeah.
Talk about uncertainty. It sounds like the transition period can magnify existing trends, positive or negative.
Exactly. And here's where it gets really interesting. The date of Inauguration Day itself has actually shifted over time. Before 1933, it was in March, which meant a much longer transition period for the market to react.
Hold on, wait a minute. Inauguration Day moved. This is news to me. Why the change?
Well, back in the day, travel was a lot slower. It took time for newly elected officials to actually get to D.C. But by the 20th century, with faster transportation and communication, that long delay wasn't necessary anymore. So the 20th Amendment moved Inauguration Day to January 20th, shortening that lame duck period.
So a logistical change. Fascinating. But let's bring it back to 2025. We've got these historical patterns. The mega cap dominance, the political transition. How do we make sense of it all? How do we connect these dots and figure out what it means for our own investments?
That's the million-dollar question, isn't it? And to help us unpack it, I want to share a thought-provoking fable. It's called The Fable of the Fast Food Worker and the Market Titans. And I think it's a really interesting story to kind of illustrate what we're talking about here.
A fable. All right, I'm intrigued. Let's hear it. Yeah, so paint us a picture here.
Yeah.
Like, who is this fast food worker? What's his story?
So you can imagine this young guy working at a fast food restaurant,
Yeah.
right? Just struggling to make ends meet. Sees that the wealth gap is just getting bigger and bigger every day. The top 1% are just pulling further and further away.
Yeah, definitely. I think a lot of people can relate to that feeling for sure.
Totally. And so he's on his break,
Uh-huh.
and he pulls out his phone, and he starts investing.
Okay.
And where do you think he's putting his money?
I think I know where this is going.
Yeah.
He's putting it in Apple and Nvidia and
Yeah, exactly. He's putting it in those same companies that are contributing to that wealth disparity that he's so concerned about.
yeah, there's a certain irony to that, I think.
Definitely. I think it's just an interesting illustration of how,
Yeah.
even people who are, feeling the effects of this concentration of wealth are still participating in it.
Yeah, and I mean, what does that tell us about the market itself?
Mm-hmm.
Right? Like, is this sustainable?
I mean, if you look at Apple's market cap, it's $3.8 trillion.
That's insane.
It's more than the entire S&P Midcap 400 index combined. So it's just this huge amount of wealth concentrated in one company. And so, I think historically when you see that kind of concentration, something has to give at some point.
Yeah, I mean, it makes you wonder when that breaking point might be.
Right, exactly. And that's what we're going to kind of dive into today is what are the signs that we should be looking for that might indicate that that breaking point is coming?
Okay, so we've got this incredibly strong bull market. It's been going on for a couple of years now. It's driven in large part by a handful of these mega cap companies. But at the same time, we've got this sense that things might not be as stable as they appear.
Right.
So where do we go from here? What are some of the specific things that we should be watching for?
Well, I think one of the biggest things is momentum trading. Momentum trading was incredibly successful in 2024 with gains over 30%. And so, the question is, can that continue?
Yeah, that's a great question. And I know you're also someone who pays a lot of attention to the role of psychology in the market. So how does that play into this whole momentum conversation?
Yeah, so there's this great quote from Melissa Brown. She's from SimCorp. And she said, momentum is great until it's not until something changes. And I think that's really key.
Yeah.
Because when everyone's just riding that wave and assuming that the good times will just keep rolling, you get this complacency.
Yeah, you just get caught up in the hype and forget that things can change. Yeah.
Exactly. And they can change really quickly.
And sometimes violently.
Yeah, exactly. And so, I think it's important to look at historical trends and they don't always offer perfect predictions, but they can give us some clues as to what might happen.
Yeah, for sure. It makes you think about the system as a whole, doesn't it? Are we all just playing into this cycle of concentration?
That's the question the fable raises. It suggests that this level of concentration, whether in society or the market, might not be sustainable in the long run.
So if we apply that to the stock market, what signs should we be looking for? What could indicate that those mega cap stocks might be reaching a breaking point?
Well, we've already touched on the weak Santa Claus rally. Another thing to consider is that only about 54% of S&P 500 companies are currently trading above their 200-day moving average. That's a sign that the market's strength is concentrated in a relatively small number of companies.
So it's not just about how high those mega cap stocks are climbing. It's also about how many other companies are being left behind. It's like a rising tide that's only lifting a few boats, while the rest are struggling to stay afloat.
Exactly. And when that happens, it creates a vulnerability. If one of those mega caps stumbles, let's say Apple misses its earnings estimates, it could drag the entire market down, even if other sectors are performing well.
Okay, that makes sense. So it sounds like we need to be prepared for the possibility of a market correction, even if things seem rosy right now. But how do we actually prepare for that? What steps can we take to avoid getting caught off guard?
First and foremost, you need to understand your own risk tolerance. How much of a downturn are you comfortable with? Are you someone who can stomach a 10% drop? Or would that send you running for the hills?
Right. Knowing yourself and your own financial limits is key. You don't want to make decisions based on fear or panic when things get bumpy.
Absolutely. And once you know your risk tolerance, You can start building an exit strategy. This means having a plan for when you'll sell your investments, whether it's a mega cap stock or something else.
So we're talking about setting some clear boundaries, maybe price targets or stop-loss orders to automatically sell if the price drops below a certain level. It's about being proactive rather than reactive, right?
Exactly. Don't just ride the wave hoping it will last forever. You need to know when to jump off before it crashes on the shore.
I like that analogy. So we've got our risk tolerance figured out. We've got our exit strategy in place. Anything else we should be considering as we navigate this potentially volatile market?
Don't forget to look beyond the stock market itself. What's happening in the broader economy? What's the inflation rate? What are interest rates doing? And what about those global political developments we were discussing earlier? These factors can all have a ripple effect on stock prices.
Right, it's all connected. The market doesn't exist in a vacuum. It's constantly reacting to the world around it. Well,
Valuations are really high right now,
okay.
and historically, when valuations are high, that's often preceded a correction.
Okay, so that's another thing to keep an eye on.
Yeah, definitely.
Yeah.
It's not a guaranteed outcome, but it's definitely something to be mindful of.
So it sounds like we need to be cautiously optimistic heading into 2025. There's definitely potential for growth, but we also need to be prepared for the fact that things could change pretty quickly.
Yeah, I think that's a good way to put it.
And that brings us back to our fast food worker friend.
Yeah, exactly.
So how does this all tie together?
Well, think about it. If those mega cap stocks start to falter, the ones that he's put all his faith in,
Right.
what's going to happen to his portfolio?
Yeah, he could be left holding the bag, so to speak.
Exactly. And I think that's true for the market as a whole as well.
Right. It's not just about this one hypothetical investor. It's about the broader implications for everyone who's participating in the market.
Exactly.
We're standing at the start of this new year, armed with insights from history, aware of the potential risks and opportunities. What are some key takeaways for our listeners?
First and foremost, don't get complacent. Just because the market did well in 2024 doesn't mean it's going to repeat that performance in 2025. Be prepared for potential shifts and corrections.
Right. No resting on our laurels. What else should we be keeping in mind?
Be mindful of that mega cap dominance we talked about. While these companies may continue to drive the market, their outsized influence also creates vulnerabilities.
And speaking of solid advice, you mentioned the importance of having an exit strategy.
Yeah.
That seems like a crucial point to reiterate.
Absolutely. Know when to take profits and protect your gains. Don't get caught up in the hype and ride a winning stock all the way down. Knowing when to walk away from the table is just as important as knowing when to sit down. The question we all need to be asking ourselves is this: when will the dip be more than just a dip?
Ooh, that's a good one. It really makes you think. We've all gotten so used to buying the dip, assuming the market will always bounce back.
Right. But what if this time it's different? What if the dip turns into something bigger? A correction that really shakes things up?
That's the big unknown, isn't it? We can't just assume things will keep going up forever.
Exactly. It's about being prepared, both mentally and financially, for whatever the market throws our way.
Okay, so that's the risk side of the equation.
Mm.
But what about the opportunity side? Like, what are some of the things that investors can do to potentially capitalize on the growth that we might see in 2025?
There are some analysts who are saying that maybe tech is a little bit immune to some of this stuff, like the folks over at UBS.
Kind of like a tech is Teflon argument.
Right. Yeah, exactly. Like
Yeah.
they're saying that tech has kind of developed an immunity to typical market downturns.
Because it's just become so essential to the way that we live and work.
Exactly. And, especially with the continued AI boom, they're saying that, the momentum in tech could continue barring some major disruption. Like if AI suddenly just fails to deliver on its promise.
Right. But even they acknowledge that there's a limit.
Right. Oh, of course.
Right.
Of course. I mean, nobody's saying that tech is completely invincible.
Right. Nobody can predict the future.
Exactly. But I think it's just an interesting perspective to consider because, for a long time, people have been saying that tech is in a bubble
Right.
and that bubble's going to burst. But it just hasn't happened yet.
Yeah. And so I think it's important to be open to the possibility that maybe this time is different.
Yeah, exactly.
But at the same time, you don't want to get caught up in the hype
Yeah.
and ignore the potential risks.
Right, exactly. Because, we've been saying no bull market lasts forever.
Right.
And so even if you're bullish on tech, you still need to have an exit strategy.
Yeah, you need to know when to take profits off the table.
Exactly. Because greed can be a powerful force.
Oh, yeah.
And it can lead to people holding on for too long and then potentially losing out on a lot of their gains.
So it's all about finding that sweet spot between maximizing your gains and mitigating your risk.
Right.
And it sounds like the key to doing that is really understanding your own personal risk tolerance.
Yeah, Exactly.
and knowing what you're comfortable with in terms of volatility.
Exactly. Because there's no one-size-fits-all approach to investing.
Right. What works for one person might not work for another. All right, so to wrap things up for listeners today, it sounds like the key takeaway is this. Be aware of the potential for both opportunity and risk in 2025.
Yeah.
Don't blindly follow the trends of the past, but rather approach the market with a clear understanding of the current dynamics, your own risk tolerance, and a well-defined strategy.
I couldn't agree more.
And always remember, this is just a snapshot of the market at this moment in time. Things can change rapidly.
Yep.
So stay informed, stay adaptable, and be prepared to adjust your strategy as needed.
Exact.
Fantastic advice. And I think the fable of the fast food worker serves as a great reminder of that interconnectedness and the potential for shifts in the market.
Definitely.
It's a story that will definitely stay with me.
Me too. Always a great discussion.
And to our listener, thank you for joining us on this journey. So stay informed, stay adaptable, and most importantly, stay curious. We'll see you next time for another deep dive into a fascinating topic. Until then, happy investing.